Hello and welcome. You're watching us here on Halftime Report. I'm Mangla Malu, with me Ekta Batra as well as Sonia Shinoy. Good afternoon, ladies. Not looking too bad for the markets. In fact, we're down but not quite out. In fact, as we speak, our markets are, a sign of resilience for the world. 17,600 on the Nifty, down just about 50 odd points. The good part about our markets is that every time the global markets decline, we decline less. And every time they rally, we rally more. And that's the kind of resilience that's reflecting in even the broader markets, which are doing well for the last many days.
Absolutely. And you know what? Domestic consumption theme, that whole theme is playing out. Whether it's FMCG stocks like Britannia, Nestle, all doing really well today. Whether it's cement, that's come back in a big way. And we'll talk more about that later. Shree Cement, Ultratech Cement. So this is clearly a space that has picked up quite a bit. Ekta, hi.
Hi Sonia, hi Manglam. Yes, absolutely. The broader markets, mid-cap index holding its head above the water, up around 2.1% at this point in time, or rather 0.21% at this point in time. But nonetheless, a lot of stocks which are buzzing around. You did mention a lot within the cement space. Autos are in focus. But even from the broader markets, if you just look at the kind of stocks doing well, Gujarat Gas, ICICI Lombard, a lot of these stocks seeing some amount of traction on the upside. So there is buying which is coming in into specific stocks and specific sectors. But we have a company lined up.
Oh, absolutely. So there's buying in the auto space, right? We just spoke to the managements of M&M, of CEAT, and they do indicate that demand trends are very strong. We have an unlisted player joining us now, Hyundai. Tarun Garg, the Director of Sales, Marketing and Service at Hyundai, is with us to talk about this big surge that we've seen in SUV sales, of course, and also the overall demand trends in the festive season. Tarun, welcome to the show and thanks a lot for joining in. There is this massive burst that we've seen in sales, especially in the SUV segment, of which you're the second largest player overall. Can you tell us what is the trend in the festive season so far? Where have you seen a pickup? And overall, what kind of growth are you looking at?
Thank you very much. Yes, I was hearing Mangalam talk about the resilience of India, and I believe that auto industry in India is a prime example of this resilience, because globally when we see, inflation, interest rates, some kind of talk about big terms like stagflation and all, and we are seeing a pretty stable and strong demand in the auto sector. And if I talk about SUVs, yes, now contributing 41% to the overall market. Last year, when it touched 34, 35, 38, we thought it was a peak, but it continues to go up, which shows that the customer is continuing to move up the chain. And as far as Hyundai is concerned, of course, festival season is looking quite good. 53% of our sales is coming from SUVs. Onam as well as Ganesh has started on a very stable note, and now we enter, of course, the Navratras and Dussehra and Diwali. So things are looking up. Also, I think what is aiding is that two things. One is that the back order is very strong. Even we are sitting on a back order of close to 130,000. And the second is the semiconductor situation, which we all have been facing for the last 1 year, seems to be easing out. So, for example, if I talk about Hyundai, January to May, we were doing about 43, 44 in the domestic market, and now we are looking at 49. So clearly a 10% uptick has happened. And so much so that now we are looking at probably calendar year 22 as the highest ever domestic sales by Hyundai Motor India in the history of Hyundai in India. So I think things are looking pretty good out here.
Wow. So your highest ever domestic sales in CY22 is what you're predicting, Mr. Garg. So that's quite a huge achievement. But if you could just give us your volume growth on a percentage basis. You said that you've seen a very strong festive season during Ganpati, Onam. Can you give us a sense in terms of how growth has been year on year? And if you had to compare it to, say, pre-COVID levels, what is the volume trajectory that you're seeing?
Yeah, so look, this is interesting. First, I'll cover the pre-COVID level. If you see the industry, 2018, the industry saw its highest ever, and even Hyundai Motor India, we did a sale of 550,000 in 2018. As we all know, 2019 was a very challenging year, and things started to kind of almost fall apart, and we saw a big dip in volumes across the industry. And then 20 and 21, COVID years, all the issues, supply chain issues. Now 22, we are looking at, like I said, highest ever, beating that 2018. So that is the first point. Vis-a-vis last year, if we see Hyundai, we achieved a sale of about 505,000, and now we are looking at 550,000 plus. So very clearly, we are looking at 9 to 10% a positive uptick in the sales numbers, and this is of course considering that we had a shortage for the most part of the year in terms of semiconductors. So this is first part of it. The second part of it is festival season. It is still ongoing because we will see the Onam results in the next couple of days, and Ganesh also 9th is the Visarjan day, the last Visarjan day. So we still have some time to go for it, but we can see a good traction. Dealers are asking for more vehicles, which is always a very good sign, and we are seeing a good booking trend as well as we build towards the post Shraddh, which will start from 26th in terms of Navratra starting. So things as of now are looking good, and because why this is more special is because last couple of months, frankly speaking, because of this geopolitical risk and because of inflation and interest rates going up and 80% of the cars being financed here in India, we were thinking and we were kind of apprehensive that how is going to affect the car demand.
Sure.
But so far so good is what I can say.
Got that. So I just want to understand, what is the market share currently that you're sitting at? You were at about 16% at the end of FY22. Where is it now?
The market share is around, if I talk about retail, close to about 15 and a half. But mind you, market share so far has been a reflection of the ability to supply more than the demand, because all of us, we were struggling with that. I think going forward, and especially in calendar year 23, as we go along, probably market share will reflect the true demand, and I think that is where we can really look at things in a much more objective way.
Right, Mr. Garg, we were looking at the industry as a whole, with Hyundai being one of the key players there, and like you said, would be one of the biggest in the SUV space itself. Can you give us a sense of how much as a proportion of overall vehicle sales was SUV, say 3-4 years ago, and what is it now? What rate is it growing at? And, what does the future look like?
So this is interesting. If I talk about, say, 2015, SUVs used to contribute 13.5 to the overall industry. And today already they are contributing 41%. So just see, in 6-7 years, 13.5 has become 41. That is first point. Second is hatches used to contribute 50%, and hatches are now 34-35%. So SUVs has emerged as the biggest segment. So very clearly a huge growth in SUVs is happening, which is a reflection of, one, that Indian customer is evolving. He is not ready to compromise on the quality of cars. He wants more space. He wants more features. Of course, the second thing is that the kind of models which are being launched. Today, more than 80% of the models which are being launched are in the SUV space. If you look at Hyundai, we launched the Tucson, last month. We already are sitting on a back order of 5,000. Mind you, we used to do about 1,000 Tucsons, the earlier Tucson, 1,000, 1,200 a year. And now we are looking at 5,000 Tucson. So just see how things have really moved as far as Hyundai is concerned, and in fact, as far as India is concerned. So more and more, we can see that the percentage of vehicles, say more than 15 lakh rupees, which used to be 1-2% of our portfolio, is now more than 15-16%. So everywhere the chain is going up and customer aspirations are going up. And also customer is traveling much more. He's spending more time in the car, which means he's looking for connectivity. He's looking for more features. He's looking for ventilated seats. He's looking for safety. All those things are really coming into the forte, rather than only just a car, as a means of going from point A to point B.
Sure. Just one final question then, Mr. Garg. In the electric vehicle segment, you have lagged some of your peers. One complaint is because the Kona is much more expensive compared to peers. Just trying to understand from you, any more launches in the EV space from the Hyundai stable, an affordable EV perhaps?
I think this is a very important point, and you have to understand the strategy. So if you see in the IC space, we started with Santro and then we moved up. In the EV is a different ballgame altogether. As you know, in 2019, we launched the Kona, and that time people were only talking about EVs, and we had a product which was SUV, range of 450 kilometers, etc., etc. So we are now working on the ecosystem. We now know much more about the customers. So supply chain has to be worked on. We talked about mass EV, which means that the costs have to come down. You would have known that we have already announced that we're going to have 6 BEVs by 2028, and which will be across segments, body types, etc. We have already announced the launch of Ioniq 5, which is the World Car of the Year and the World Design of the Year. So very soon you'll hear from Hyundai about the launch of Ioniq 5. I think going ahead, we are very much committed to launch of more battery electric vehicles, and the charging infrastructure, we are working very strongly. We have had a partnership with Tata Power on that. So I think we're looking at the entire ecosystem rather than only the product. And you will be hearing from Hyundai in this space, very, very frequently.
Okay, all right, Mr. Garg, we're going to leave it on that note. It's been a pleasure. Thank you very much for talking to us and giving us your plans in terms of the SUV space. And while the whole of, I think, the country loves SUVs, I really wish, at least for Mumbai, we had the roads to accommodate the number of SUVs we see on the road. But nonetheless, Mr. Garg, thanks very much for joining in. So that is Hyundai. We need to take a short break. A quick reminder for our viewers, is that time of the year again. Money Control Pro's financial freedom offer is back with added benefits. Get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on Money Control app or the website.
Welcome back. Well, we just had a conversation with Tarun Garg of Hyundai talking about the auto space and the big demand that they've seen during the festive season. So we're going to take that discussion forward on our value add segment today. We are focusing on the auto sector. We spoke to top auto and auto ancillary players about the big surge in auto demand and growth trends for the industry. And here's what they had to say. M&M, who has now become the second largest player by volume in the SUV market, has said that their utility vehicle market share has now risen to 17%. This is because of the stellar response to their new products. And they also speak about how in the tractor industry, after many months, government spending has now picked up, and that is aiding tractor demand. They hold on to their guidance of a 3 to 5% growth for the tractor industry in FY23. And let's not forget, M&M is one of the biggest Nifty gainers this year. The stock is up about 54% in 2022 itself. We also spoke to CEAT, which is one of the top players in the tyre market, and they said that they're expecting a 15% revenue growth in FY23. They hope to get back to double-digit margins by the end of FY23 itself, and they maintain their guidance of a 750 crore capex that they plan to spend in FY23. Now, let's not forget that tyre stocks have surged quite a bit. CEAT is at a 52-week high. It is up 17% in 2022 so far, and it's still not expensive compared to peers like MRF. If you look at it, CEAT is trading at about 15 times FY24 PE, and the historical average for CEAT has been somewhere to the tune of 13 times. So, not too bad compared to its own historic average and to peers. But let's listen in to what the managements of both M&M and CEAT had to say.
Our view at this point of time remains the same, similar to what we had a month back, which was 3 to 5% growth for the industry. Depending on how the festival season actually pans out, we may take a fresh look at that growth estimate sometime in the month of end of October, after the festival season, early November. So we'll wait to see how that happens. But right now, there are several positive indicators.
The Capex Outlook that we gave in the beginning of the year for the current year is about 750 crores of project Capex and about 150 to 200 crores of routine Capex. Okay, and we keep reviewing this Capex on quarter-on-quarter basis, depending on our operational cash flow and overall debt levels. So therefore, as we stand by that earlier estimate. Overall, year-on-year basis, okay, we would have strong growth in the current year versus last year. I think I expect it to be in the double digits. Okay, see, quarter one, we grew by 50% over the same quarter of last year. But however, I just want to highlight, last year, quarter one, we were impacted by wave 2 of COVID. So therefore, it's not a clear comparison. I think we expect a strong double-digit growth in the current year, assuming that there is no impact on account of pandemic in the current year. So as we said, a volume plus value growth would be high double-digit number, anywhere between around 15% types is what we are looking at this point in time.
Okay, so that's on the entire auto space. Let's move and focus now on a large deal which is possibly brewing in the pharmaceutical sector. Sources suggest that Suven Pharma is in fact on the block. Nisha Podar is here with the exclusive details on this. Nisha, go ahead.
Thanks so much for that. And yes, three independent sources with direct knowledge of the development at Suven Group have shared with us that Suven Pharma, which remember was demerged, and Suven Life Sciences, Suven Pharma were demerged about a couple of years back. So Suven Pharma has been put on the block by the promoters to raise funds to infuse in the drug development business of the life sciences company. That's what we are gathering from sources with direct knowledge. Now, we do gather that Suven Pharma has even hired an investment bank to really advise them on a controlled deal where they are ready, where the promoters with 60% stake are ready to sell their stake and give a majority control to the incumbent buyers. Now, we do gather that some of the private equity players who have been very, very focused and bullish on the pharma space in India have been showing a good amount of interest there. And apart from that, some of the strategics have also spent time, and the investment bank is in talks with all the possible suitors at this point. Now, remember that Suven Life Sciences, that is a company in molecular development, which is a cash guzzling company, and that has been utilizing the funds which the promoters have been really getting out of the dividend that they earn from Suven Pharma, and that has been infused. In fact, recently in this year, middle of this year, Suven Life Sciences had even called for a rights issue to raise 400 crore rupees. But since the requirement of Capex is so high in Suven Life Sciences, we do gather that the promoters have taken a call to really monetize on Suven Pharma, raise funds, and then focus on the life sciences business. So at the moment, preliminary talks have really started with several incumbent suitors and interested parties is what we gather. Suven Pharma will be the focus. We did reach out to the company with the query, but did not get a response on these particular deal talks. And they did share that in Suven Life Sciences, they had announced rights issue earlier on.
All right, Nisha. Thanks a lot for that. So that's an exclusive about Suven Pharma being on the block. But just don't lose sight of the market right now. The Nifty has recovered about 150 points from the lows, virtually about to break into the green, down by just about 30 odd points. So that's the kind of massive recovery that we've seen. And the biggest reason for that is the recovery that we're seeing in the IT space. Now, remember, the IT stocks have been in a bear market all through this year. From the peak, the IT index is down about 30%, even as the Nifty is just about 5% away from its all-time high. And now we're seeing some recovery bounce back in the IT pack. It's led by Infosys and TCS, the two large players out there, and that is causing the market to recover from the lows. What we'll do is take a short break and focus on the markets itself. Sudeep Shah of SBI Securities joins in. The rally in IT stocks, it continues, and it's moved on to, the mid-cap IT stocks as well. Just keep an eye out on a couple of these names. You have First Source, which has moved to the high point. Alongside that, we have Coforge as well, which is spiked now. L&T Infotech, Emphasis, Mindtree. In fact, among the top 5 gainers in the F&O space, 4 of them belong to the IT space, and one of them is in the cement space right now. So the cement space has been buzzing all through today's trading session so far. The IT pack is the one which is, led another big leg of recovery in our market itself by the big move that we're witnessing out there. Sudeep Shah joins in on the show now. Sudeep, any dip has been bought into with a lot of resilience. How long does this continue for? And the IT stocks, I mean, is it just a trading pop that we're seeing from oversold levels, or something new do you think has begun with the kind of move that we've seen in the last few minutes?
Good afternoon, Mangalam. Absolutely right. Post the early morning fall, what recovery we have seen, that is courtesy IT stocks, and we have not seen any much bigger support from the banking names today, which have already outperformed in the past many weeks now. So, but the move today that we are seeing in the IT stocks is just a rebound move from oversold zone, and we are not reading too much into that. It's just a better thing that it is supporting the markets today, a rebound move in IT. But if we just try to connect the dots now, although there is some profit taking in the past few days in global markets and dollar index have been moving above 110, but with crude in a downward trajectory, that is what is making us more confident that the markets could be in a bullish state even in the coming few days. And although there could be some consolidation between 17,400 and 17,800, 850, but dips would be bought, and we feel sooner or later we would be crossing 17,800 and moving towards 18,000, 18,100.
Okay.
Okay, all right. Sudeep, I just had a quick question with regards to the auto stocks, because that seems to be one of the sectors in focus today along with cement. But what would your view be there?
The auto stocks, if we see Eicher Motors, first of all, let us take auto sector. Now, auto sector has given a 5-year breakout and has been trading above that since last many weeks now. So, a sector which gives us breakout on a larger time frame will always witness continuation move on the upside. And from that space, what we like is M&M, we like Maruti as well as Eicher Motors. And all these three stocks, if we have to look at them individually from a positional perspective, they could give us returns of anywhere between 10 to 15% in the coming few months.
Okay. All right, we'll leave it at that. Thanks a lot for joining in. Let's slip into a quick break. On the other side, we'll get you more on the markets and stock-specific action. Do stay tuned in.
While the IT stocks are doing well, we do have the FMCG stocks which are seeing some profit taking after doing extremely well over the last few months. So now HUL is the one which is at the low point of trade. But in focus is the pharmaceutical pack, and we are watching out for Biocon in particular. Ekta, you have a value plus on Biocon, our special segment?
Well, yes, Biocon has been in focus in the past week odd. First was those 11 observations that Biocon Biologics themselves, the units got a couple of days ago. 11 observations each in their Bangalore facility, 2 of their plants, and then 6 in their Malaysia plants. So the street was quite disappointed with that. But separately, now Biocon also sold stake in Syngene, 5.4% stake. The deal took place yesterday. Over 1,220 odd crores is what they garnered, which is around $150 million odd. Now, why exactly did they do this? That is because they're funding the equity component of that $3.3 billion acquisition of the biologics business from Viatris, which they announced earlier in Feb of 2022, and they said that they're going to close the deal by the second half of this fiscal. Now, according to Biocon Biologics, when this entire deal was done, they will have to pay $2 billion to Viatris at the end of the deal, which is at the closure of the deals. So how is this $2 billion going to be funded? $800 million is the equity component, and $1.2 billion was expected to be the debt component. Now, $800 million of this equity component, $250 million was expected to be a commitment from Biocon, and $550 million from other PE investors, including the likes of Serum. So the $150 million that they've raised from selling stake in Syngene is going to go into that $250 million total equity component of funding the Viatris deal. So that means that they'll have around $100 million additional left. We did speak to Biocon. They had a couple of important takeaways. They said as of now, they're not looking to sell additional stake in Syngene. Remember that stake has now fallen to around 64.56% versus close to 70% earlier. They do, in fact, also have a 90-day lock-in for promoters in Syngene, so they cannot sell any more stake for 90 days. They are exploring other options to raise that additional equity component that I spoke about, which is around $100 million for the Viatris deal. Multiple fundraising conversations are underway as per the management. They are in fact seeing strong demand for equity infusion in Biocon Biologics, and Serum could put in an additional $300 million in Biocon Biologics. Remember, they invested around 15% already. They could probably put in $300 million. On a diluted basis, Serum could be holding around 12 to 13% as per the company. Debt equity ratios being worked out. So if in case they do get a lot of equity component, interest, that $800 million could go up, and that $1.2 billion in terms of debt funding could go down, and hence they could see a higher equity component versus debt. So these are important takeaways. It's an moving story, moving part story, because if there is further equity funding which Biocon would probably look in, there could be further deals which could happen in the group companies.
Okay, by the way, just take a look at the market. The mid-caps are outperforming in a big way now. So you have a lot of stocks that are picking up pace, whether it's something like a Lakshmi Organic that's up almost about 5%. You have Angel One that has gone up about 4.5%. Demat accounts have surged, we know that. and looking pretty good over there. Something like a Galaxy Surfactants, Dalmia Bharat also looking pretty good. But Ekta was talking about Biocon. Earlier today we spoke to Siddharth Mittal, who is the Managing Director and CEO at Biocon. He talks more about the deal. Listen into what he had to say.
Biocon Limited, which is a parent of Biocon Biologics, has to pump in minimum $235 million contractually. And to part fund this investment, we have raised $150 million by divesting roughly 5.5% in Syngene. And now with this sale of Syngene, we do not expect to divest any more shares in Syngene. And we also have committed to a 90 days lock-in to the investors who have invested in this block trade.
All right, and the other sector which is buzzing today, all through today, and we've been talking about it, is the cement space. Shree Cement and Ultratech are the biggest gainers on the Nifty, with the other broader market cement names gaining anywhere between 3 to 6% as well. Nigel joins us with more. Nigel.
Well, that's right. Let's break it up into two parts, the larger names then. ACC and Ambuja, remember all through this year, they have done a relative outperformance. But otherwise, the traditional, traditional stocks that find favor with the market have been Ultratech as well as Shree Cement. Both of them have been relative underperformers. So for ACC and Ambuja, it seems that the street is now baking in. A new, more aggressive promoter comes in there. That's the Adani Group. And that's why, they'll be more aggressive in the market. Remember, they've been losing market share. So that's about ACC as well as Ambuja Cements. Actually, the stock prices performance in 2022 should come up for you. For Shree as well as Ultratech Cement, it appears that they have underperformed by around, 10 to around 15% lower in this year itself. So they have underperformed the other two, and they are playing a bit of catch up. So that's why those stocks are running along. In fact, for Shree Cement, which has been a rank underperformer, it was, out of the Nifty. It's all that announcement has come about. In the run-up to that announcement, we did see a lot of selling. So that's playing a bit of catch-up out there. Now, on a valuation parameter, Ambuja Cements, that's relatively more expensive in comparison to ACC. But keep in mind, any kind of expansion is likely to come about from Ambuja Cements. And Ambuja Cements' profitability is better than ACC. The problem for ACC, what the street understands, is that they have a bit of a limestone issue. Ultratech as well as Shree Cement, they've always traded at higher multiples in comparison to this group, and that's still the case. Now, 5 big reasons why, in fact, the street is getting optimistic on the cement industry. One is cement prices have been increased across the board, all across the country, north, east, in parts of south as well. I understand that in south, it could be a little difficult to push it through, but in north as well as east, it's likely to get pulled through. And Bidla Corp management, they indicated that demand is strong enough to absorb that. Pet coke prices are down by close to 25% domestically. International prices, pet coke prices are down far more. So that could result in 200 to 300 rupees per ton saving for Q3 FY23. So the street is baking in that Q2 FY23, it could be basing out or bottoming out of margins, and they could see a recovery from here as volumes pick up, pricing picks up, and input costs cools off. Post-monsoon, we know demand bounces back, so that's likely to play its role as well. Strong demand in the second half of the year is what the street is factoring in, and hopes of some bit of consolidation that could potentially play out. That's where you're seeing some of these smaller names, potential targets, so to call it, whether it's Sanghi Industries, India Cements. The street believes that there is something going on out there. We don't have any confirmation, but those stocks just in the last 1 month have seen a big run. Back to you guys.
All right, Nigel, thanks a lot for that. So that's a roundup of everything that's taking place in the cement space itself, and those stocks are buzzing. Apart from that, we do have a bunch of other stocks which are surging as well, and most of them belong to the consumption space. Specialty restaurants up 11%. EIH is the other one which is up 11% and giving us a company on that is Barbecue Nation out there with regards to, the kind of consumption moves that we're seeing. Barbecue Nation, in fact, has just informed the exchanges that they're meeting analysts today. So that's the other stock, which is up around 5% But let's go back to the cement space itself. We caught up with Rajesh Ravi of HDFC Securities, and he tells us that he prefers ACC versus Ambuja Cements owing to valuation comfort. Listen in.
Among the two stocks, ACC and Ambuja, the valuations is much comfortable in case of ACC. While Ambuja on a standalone basis is trading north of $180, $190. So we obviously believe that ACC has more valuation comfort as a standalone entity. The stock is trading at less than $110, $120 today, at $120 per ton. So we find ACC to be more comfortable and more, we find there is more upside in case of ACC versus Ambuja.
Price fall would vary from region to region, but my sense is it will be in the range of 150 to 250 rupees per ton. We have recently increased price in the eastern and the western regions to the tune of 15 to 20 rupees.
Okay, that's the cement space which is buzzing in a big way. Let's slip into a short break. On the other side, we'll connect with Arun Chittilapilli of Wonderla Holidays to discuss the demand picture. Stay tuned.
Welcome back. Well, it is holding up for the mid caps, up around 0.2%. We have the Nifty, which is down around 0.2%. So good time to get chatting with a couple of companies then. Wonderla Holidays is the one that we're tracking today. The stock, in fact, is a rank outperformer. It's up 76% this year and is among the top gainers after what was a strong Q1. Arun Chittilapilli, who's the managing director at Wonderla Holidays, joins in on the show to discuss business with us. Arun, hi. Welcome to the show. Well, Q1 was strong. You've done well in terms of footfalls as well, and we've attributed it obviously to a recovery post-COVID. Tell us how Q2 is going, and what is your guidance for the entire fiscal? Do you expect to sustain that Q1 performance throughout, or was a large part of it also because of pent-up demand?
Yeah, so for us, Q2 is also looking pretty strong because like you said, the pent-up demand is still there. People have not been able to go out of their homes and go out for outings. And so we are seeing a strong revival in demand. Of course, Q2 is not traditionally a very strong quarter for us. It's one of the weaker quarters because of rains and, all those kind of things. But still, it's looking pretty strong. I think we should do better than pre-pandemic numbers for sure. So it's looking pretty good for now.
Arun, what do you make of the kind of rains that we saw in Bangalore over the weekend? You have a park in Bangalore, you have a resort in Bangalore as well. Are people scared of, stepping out, or irrespective of the rains, you have seen footfalls come by or be normal in your Bangalore park?
So, it's unfortunate what is happening in Bangalore right now, but we are not new to this kind of rain. In fact, it has been raining in Bangalore on and off for the last 4-5 months. We never really had a hot summer this year. There's definitely a change in weather patterns. But having said that, that has not really affected our footfalls so far. We are not in one of those low-lying areas. And also the misconception is that the whole city is underwater, but that's not true. It's just a few low-lying areas which are underwater, and that's unfortunate. But I think majority of the city, a lot of areas are pretty okay. So it's not too bad.
Okay, that's good to know. Since you're an amusement park company, I have to ask you about that unfortunate incident that happened in Mohali, right? Where there was that rotating drop tower ride that suddenly crashed and 50 people were injured. Now, Mangalam was telling me earlier that you guys manufacture some of your own rides. What do you do to enhance the safety protocol? And do incidents like these generally impact overall demand as well?
See, I don't know what has happened in this Mohali park, and from what I understand, it's it's like a temporary park, and with probably locally made equipment. I'm not sure, and I don't know what kind of maintenance and safety standards they follow. But we, even if we make our own rides, they are built to a very high tolerance and international standards, and a very high degree of safety. So when you don't have that, and when you don't do the maintenance properly, is when you have these kind of issues. And I'm happy to say that Wonderla has definitely been one of the flag bearers for top safety and hygiene in the country, and we've rarely had these kind of incidents. So that's, I think it depends on each operator and each person how they procure the machines and how they maintain the machines. So it'll depend on these two factors.
All right. Arun, just following Sonia's point, from a business standpoint, is there any kind of standardization of safety protocols which is followed in India? And could that in fact be a risk to business if in case there is no standardization of safety protocols?
Well, there is no standardization of, there is the Bureau of Indian Standards, and we have, inspections from different authorities from time to time. In fact, we have to renew our licenses every year in most of the geographies that we operate in. So there is a lot of checks and balances in place. But having said that, these kind of incidents can occur. And if you look at the world news and the amusement park scene, you do hear once in a while these kind of things happening. That's unfortunate, but I think majority of this can be avoided. I don't think it can be completely zero, but I think it can be definitely minimized. And it calls for a lot of care from the operator and the staff and training and those kind of things also. In that sense, it's kind of the analogous towards with the airline industry also, right? Wherein there are big machines and that need to be maintained properly.
Take that point, Arun. Finally, before we let you go, I presume you would be taking insurance against all these incidents as well. You spoke about new parks. Odisha was a place under consideration. Have you finalized the land for that? That's point number one. And secondly, about the management contracts that you were seeking, what's the update?
So for us, Odisha we finished our land acquisition. In fact, we are in the process of designing our new park in Odisha. In Chennai, we actually have already acquired the land. We are just waiting for the Tamil Nadu government to, help us with the local tax that dispute. We wanted to, finish that before we go ahead with the project. But as it stands, it's looking favorable. We are hoping that we can start working on these two geographies fairly quickly. Management contracts are still, it's still an early phase for us. We are still, talking to different players. As and when we have an update, we'll definitely share with you.
All right. Thanks a lot, Arun, for taking all of our questions and joining us on CNBC TV18. That's Wonderla Holidays. Let's move on, though. Manisha Gupta is joining in with a roundup of all the commodity and currency market action. Manisha, over to you.
Sonia, thank you so much for that. Well, I'm looking at the oil and gas and overall energy space where you have seen some profit taking for crude oil prices, even gas for that matter. But the coal prices, they are trading at an all-time highs. And to discuss all of that, we are now joined by Peter McGuire. He's CEO, Exim Australia. Peter, hi. I want to start with coal first because all-time highs there and there is a lot of switch from gas to coal, as we understand, happening in Europe and US as well. So at $460 per ton for coal prices, where do you think we are headed?
Well, Manisha, I think I need to be a coal miner because the profits are just outstanding. So I think it's obviously going to go up from here. We're conscious as far as what happens with Gazprom and as far as European demand heading into the winter. Nuclear thoughts across Germany and certainly across the Eurozone. So I think that coal, that's certainly going to trend higher from where we are at the moment.
Right. The gas prices then, and Monday was a knee-jerk reaction. We did see prices run up by more than 30%, and then Tuesday and Wednesday we are looking at some profit-taking continuing into this space. How are you looking at right now, and how do you look forward to the European energy meeting, ministers meeting on Friday? You have the UK new PM going to release a new policy perhaps on oil and gas on Thursday. So these are going to be important days and events.
Absolutely, Manisha. I mean, look, we've got so many moving parts all coming together at one time. You've got new PMs, you've got all sorts of strategies being developed on the fly and how they're going to manage all of this moving forward. And the other side, of course, is that we're only really about, the best part of 8 or 9 weeks until you've got very, very cold conditions, certainly in Scandinavia, and then moving south across Eurozone. So time's ticking for them and it's not ticking favourably. This isn't like we're doing this in March. We're doing it in, the first or second week of September. So yes, we've got to move very, very quickly to see how they're going to manage all of these considerations as we head into a cold winter.
Mm-hmm. Peter, this year we've seen gas prices range between $3.5 on the lower side to almost 10 on the higher side. I mean, that's a huge range that we've seen in this year. For the remaining part of this year, what is the range you're working with?
Well, I think we're going to move higher from here. I know that I've been looking at NYMEX and you're sitting at around that $8 level, so it's given up a fair bit of that hot steam. But I wouldn't be surprised you're going to have another uptick. So whilst you're going to see volatility, we haven't seen any weather outages as far as nat gas in the States. But remembering that you're very close to that, hurricane season, and that can really disrupt the market considerably. So we haven't had that to deal with as yet. So, yes, I think it'll edge up higher from here. I can't put a ceiling to it, but I know it's going to be wild and it's going to be a very, very rocky road.
Okay. And how would you look at the crude oil prices? Because we've seen a long string of profit taking here, and not too many people are talking about 115 now. More and more people talking about 85 or even 80 for that matter. We've reacted to the OPEC and allies cutting production by 1 lakh barrels, but that clearly isn't such a huge number. What are you looking at in sense of demand, especially from China, the strength in US dollar being some of the factors that are weighing on crude prices right now? But here as well, how is the rest of this year looking?
Well, I think that's exactly the first part is we've got a record high US dollar. We can't believe where it's at, 110.50. So, yeah, it's been just extraordinary what we've seen as far as a big push up. Absolutely cratered the yen. Euro was sitting under 99. So, yeah, there's just so much hurt out there. And these are the other side of it. As these currencies crumble, that adds more inflation. So there's the first part. The second part is, yes, I understand the Saudi situation. I understand underwhelming with 100,000 barrels. So, yeah, I'll give it up. I'll say that we're probably in a pullback at the moment, but I don't suggest it's going to stay there for that long.
All right. So you don't believe that this profit taking or the decline that we are seeing in energy price could last longer? Short term, yes, there's a bit of a decline, but there are just so many uncertainties that could really be supporting these prices going forward. Thank you as always, Peter, for joining us and talking about everything energy, oil and gas in focus there. With that, that's all the time that we have on Halftime Report. Stay tuned. Business Lunch is coming up next.